Okay, welcome back to another edition of Find My Way Home. I am Scott Shang, and I am joined today by Evan Wade, who is the owner and a loan officer at Philadelphia Mortgage Brokers in Philadelphia. And Evan is a veteran housing advocate. Really, Evan specializes in VA loans and the guidelines around VA loans, and he's really one of the smartest people that I know when it comes to VA loans, and has really been able to pull off some amazing stuff. If you haven't seen my expert interview with Evan, get to know him a little bit better. Definitely search for that on Find My Way Home or wherever you're looking, wherever you're seeing this. And definitely look out for a lot more videos. We've got a lot of stuff to cover that folks aren't, situations that veterans are getting in and not getting the right answers. So, Evan, welcome back. Thanks for being here.
Thanks for having me again, Scott.
Sure. So on effective May 25th, any application that was submitted after May 25th, the VA took a really, really huge step to stopping predatory lenders from preying on veterans. Why don't you tell me a little bit about what the problem was and what the solution was?
Yeah, so it is revolving around the specific VA refinance product. We call it the VA IRRRL, which it's IRRRL, which
I always have to think of that too.
For interest rate reduction refinance loan.
Okay.
It's a great product. It's a way for veterans to take advantage of a lower interest rate environment if they if they bought a house when the rates were higher. So a lot of people over the years and the last couple of years with interest rates being extremely low, people have taken advantage of it. The problem with it is that it's both a good and bad thing because it's an extremely easy loan to do. It's probably the easiest.
Yeah, it's also known as like a streamline refinance, yes. Right? That it has very reduced.
Very minimal documentation needed. We basically pull a credit report. Sometimes don't even need a full credit report, just a mortgage history. And
no appraisal in most cases.
No verification, no appraisal, no asset verification. We were basically just making sure you have a job still and that you at once occupied that property. You don't even need to actually be occupying that property currently to take advantage of it. You just have to certify you lived in that property at one point as a primary residence. So since it became so easy to do it, when you have that low hanging fruit, a lot of companies will just do an insane amount of marketing and direct mailers. I know some veterans are getting probably 5 pieces of mail a day, trying to get them to take advantage of an interest rate reduction refinance loan, an IRRRL.
I would say entire businesses were built around.
Oh yeah, there's
going after these.
They were just sanctioned by Ginnie Mae and kicked out of the primary pool, investor pools for selling loans to Ginnie Mae, which securitizes VA loans.
Let me unpack that super quick because you mentioned it. So essentially, VA does not offer loans. VA guarantees loans. So if you're an eligible veteran, the VA will offer sort of like a gap insurance sort of thing. So if there's ever a default, they will pay the lender. They will help the lender recover their costs. And in effect, that allows veterans to borrow 100% financing without putting a down payment. Now, those loans are typically sold on the secondary market, and that's where Ginnie Mae comes in. You hear Fannie Mae, Freddie Mac. These are similar things. These are secondary markets. And the Ginnie Mae who gets these loans, they were noticing something, weren't they?
Yeah, they were seeing that a lot of these loans they were actually damaging the portfolio of all these pool, because when the loans sold to Ginnie Mae, they package them up in a bunch of loans into one bond essentially, and that gets sold on the secondary market.
The
And
mortgage-backed security.
since we all learned our lesson from 10 years ago, they're looking at the loan quality of these pools of loans, and they noticed that these loans were actually very dangerous because a lot of them were, they were getting a lower interest rate, but they were going from a fixed rate to an adjustable rate mortgage, sometimes like a 3-1 ARM where, it's only fixed
quickly.
And people were taking them because it looked like, they were getting a 2.75 rate, with a 3-1 ARM. And then you're also paying, 1, 2, sometimes more points in discount points to buy down that rate. So,
and there wasn't any limit. So like they would do it, and then 2 or 3 months later, they were refinancing it again. So when as an investment vehicle, if you have an investment and then it pays off 2 months later, that's not a great investment vehicle. There's really no time for that thing to mature. And
longer term investments.
Yeah.
So it was based. Yeah, that was where it became alarming. And there was a lot of other watchdog type situations out there. I'm a member of a nonprofit organization called VA IRRRL, and they were also really going to Congress and all that, saying and the VA saying you got to stop this because it really, at the end of the day, the biggest danger was we were stripping veterans of their equity in their home. So,
And how does that happen? What happens there?
So,
I mean, you said there was
come out of pocket for any of those expenses for the refinance. It was just
being rolled into the loan
amount than what you had before. And a lot of times you were resetting. So maybe you're 5 years into your loan and they're refinancing you into a new 30 years, adding, $6,000, $8,000, $10,000 in closing costs on the back of that loan, and you're basically just kicking the can down the road, and you're never building what. And the whole reason you buy a house is to build wealth, essentially. You own a property, and I think some of the studies say that 65% of our wealth created over the last 80 years is from real estate.
Absolutely.
So when you allow these predatory lenders to come in and offer these products to veterans that they think is a net tangible benefit to them, but really isn't, it can be very damaging to the financial well-being of people who went out and protect and serve our country.
So what you said is, so veterans, and most of them are getting 30-year fix, and then they're kind of getting hit with these short-term. You said an ARM. This
didn't always
these
happen.
Videos go out to consumers. That's an adjustable rate mortgage, but the tricky, kind of the deceiving part about it is it's fixed for that initial period. So a 3-1 is fixed for 3 years, and then it turns adjustable once a year after that, which are particularly dangerous in today's environment, where all of those indexes, everything that those adjustable rates are based off of, are rising, where they weren't for the last 10 years or 7 years or 8 years. They were going down. So a lot of people that used to have adjustable rates, so those adjustable rates are still a little bit lower. So there's a very deceiving marketing ploy that's going on, and they're giving veterans partial information.
Yeah, and hey, ARMs are still out there because they are a great product for the right
absolutely
for the right in
the right situation.
What experts like us advise whether a 3-1, 5-1, 7-1 ARM makes sense for a borrower in their particular situation, and no borrower's the same. But yeah, I mean, they were just putting veterans that plan on living in this property, it's their forever home, but they're putting them in 3-1, 5-1 ARMs, and it just didn't make financial sense at all. Like any lender that puts the interests of a borrower first would never do that to a consumer.
And like we mentioned before, I mean, entire businesses popped up around this where, and we touched on this on our interview, and we talk about it a lot on the site. If you've heard of a mortgage company, chances are it's a telemarketing room, and there's millions and millions of dollars behind putting them in front of your face. Guys like you and I, we can't afford Super Bowl commercials. We're hanging out here for free on Facebook, trying to do videos, trying to help as many people as we can.
People are going to watch it.
Yeah, praying it open that somebody, the right person, sees it or shares it or something like that. But no, these businesses survive by hiring tons of telemarketers, sending out tons of direct mail, and nobody looks at the fine print or reads the fine print, and all they're talking about is the hey, we're giving you a lower rate, we're giving you a lower rate. Oh, don't worry about how we're doing it. We're just giving you want a lower payment, don't you? Who's going to say no to that, right?
Sounds too good to be true. It usually is.
Yeah, well, our industry has a habit of finding those loopholes. So it really was, when we say predatory, it really was a predatory situation.
There's
they were targeting a specific demographic and putting everything they had with a very limited a message that was very factually limited, and putting them into a bad situation. Now, FHA, which is another government-insured, sort of government-backed loan program, they have a streamlined refinance product as well, but it has criteria. You had mentioned net tangible benefit. It's a little nerdy for the average person probably, but essentially it means it has to make sense.
Yep.
Right. So it has to benefit you is the bottom line. So what did VA do to protect veterans?
So there's two parts to it. The first part is all of the fees and costs involved with doing this refinance loan has to be recouped from the lower interest rate in 36 months or less. So those closing costs that are added onto your loan, that it's not out of pocket, but it's added to your loan, those costs you need to realize those savings from that lower interest rate in 36 months or less.
And we'll put the math on the article that we're going to put this video on the website. But essentially, what you're talking about is if you have $100 in savings, if your payment goes down by $100, then you have that $100, you have to be able to pay for whatever. So if there's $3,000 of closing costs, right, you're dividing that by $100, and it has to be within 36 months of break even.
So $100 savings, the closing cost couldn't exceed $3,600, essentially.
And what people need to realize is that what that essentially means is you didn't save money for those 3 years. So you go into a 3-year ARM and then the rate starts to adjust. Guess what? You didn't save a dime because you just ate it, because your equity is your savings. That's your retirement plan. And you didn't make any money. It's a shell game essentially. Okay, so they implemented that net tangible benefit. So now you have to be able to do that calculation and prove that it's going to work. But I think it really, really important to understand you are not benefiting while you're in the payback period, right?
Yep.
I mean, your monthly payment might be lower, but you didn't save that money. You spent that money in order to have the lower payment.
Yeah.
Okay.
So that's the fee part. The other part is that when you if you're going from a fixed rate to another fixed rate, the rate has to reduce at least 0.5% with the new loan.
Sounds reasonable. That's what FHA requires.
Yep. So that's fixed to fixed. And then if you want to go from a fixed to an adjustable rate, it actually has to go down 2%.
Really?
2%.
Okay.
So it really has to, be a significant drop before an adjustable rate mortgage from a fixed rate makes sense.
Okay. Yeah, no, that's It's so funny. It's so funny how long these things happen before somebody does something about it, and you have another government entity that already has those
Yes.
requirements. Now, I know with FHA, it that includes like the mortgage insurance, right? So does the guarantee fee or anything factor into that, or is it simply just straight interest rate?
That's a good question. I do. I know that the funding fee for an IRRRL, because you do pay a new funding fee, so you pay a funding fee if you do pay the funding fee. If you're a disabled veteran, you don't pay the funding fee for the purchase or a refinance. But if you do have to pay the funding fee,
It's a 0.5%, right?
Yeah, it's 0.5%, and I do not know if that is included in those costs. I would hope it is.
You would hope, but it's guys like us that do this every day, not politicians that are doing these things. So you don't really ever know. But that's another trigger, though. That's another trigger that these refi shops use is hey, the funding fee is only 0.5% instead of 2 1/8 or whatever. Or
a lot of money. $200,000 loan.
Yeah, and it's financed into the loan. Again, it's the same predatory practices. It's the whole, hey, it's not coming out of your pocket, right? But it's coming out of your home, and that's a lot more. I would rather have somebody in my pocket than in my home.
Absolutely.
Okay, so anything else significant about this? Isn't there a waiting period? Isn't there a time period that is required?
Yeah, you need to be in your current loan for at least 6 months.
So is that 6 payments or 6 months? I believe you have to have made 6 payments, correct?
Yeah, I think that is correct. We'll read it direct from here.
Yeah, hey, these things, these are new guidelines, and these are the questions that, Evan and I are going to know and going to ask. And in all fairness,
200
we're springing these things at each other right now, kind of in real time. So we're doing our homework on the fly.
It's the later of 210 days and the date on which the 6 monthly payment is made on the loan. So yes.
Okay. Yeah. So typically, mortgage payments are made in arrears. So that's sort of another kind of predatory. It's not predatory, but it's, lenders that say, oh, you get to skip a payment. It's not actually true, but it's just the way that it works, and it is a benefit. So say you closed your loan in July, your first payment's due on September 1st for the principal and the interest accrued for the month of August. Mm-hmm. And so then you have to make 6 more payments after that. So I think this is absolutely fantastic news. I think this is amazing news. I don't think it makes sense in any scenario. I don't know if I've ever experienced market conditions where somebody should refinance 2 times in a year. I mean, it would have to be a major,
very significant. The only thing I can think of is you purchase a home and something happens in the market and the rates drop.
That's rare.
0.5% in those 6 months, and then you have to think that the market's going to bounce back. Our cycles just don't, unless there's some sort of catastrophic event that drives the bond market to do that. I just don't see how it could sway that quickly.
And if that does happen, it'll still be there in 6 months. That you don't see that kind of boomerang.
Extremely rare if it's ever happened.
Yeah, I mean, there are definitely situations. Okay, so here's a scenario that I thought of because I'm going through my head and I'm thinking, okay, how are these companies that are spending all that money, have all these employees, they're not going to shut their doors tomorrow. And the same guys that said, hey, let's take advantage of all these veterans, they're in there and I can smell the smoke from the gears grinding of them trying to figure out how they're going to find a loophole in here. I mean, really, the only thing I can possibly think of is if a lender is purposely giving a higher interest rate and then putting them on their calendar to call them back in exactly 6 payments. That seems silly.
A lot of those lenders didn't actually aren't the ones who actually originated the purchase loan. That's the thing. So,
that's right. They just went to public records and saw that they were.
I don't want to name mortgage companies, but the ones that were sanctioned by Ginnie Mae, that they didn't do the original. So they either existed solely to do direct marketing to capture, because when a mortgage is recorded with the county, there's a VA rider attached to it. Everybody knows if you get a VA loan. That's how they can figure that out. So anybody who wants to pay for that public data can send those mailers out. So a lot of these companies were created for the sole purpose of only doing those refinance loans, and they paid the money to acquire those customers. It was either that, or you have what we call wholesale lenders who do have a retail presence, or you leverage people like me and you, Scott, who are mortgage brokers, and they capture the borrower from us actually originating that loan, and then is virtually free because they can just pick up the phone and call them because they have all that borrower's information, and then that's when they can churn them, because we put forth that effort to acquire the customer, whether it's through a relationship that we develop with a referral partner or any kind of marketing that we pay for, trying to capture that lead, and then they just steal it. And that would never happen in any other industry, and it only exists in ours pretty much. When you have third-party origination. Yeah, like if we were financial advisors, a Vanguard could never go after some other financial advisor's clients, because there would be a mutiny, and they would never, those companies would go out of business. So for some reason, it's been allowed in our industry for so long. And fortunately, we're getting into an environment where that's going away. A lot of it fixed itself because the interest rates are going up, but financial experts are predicting some sort of recession in about 2 years or so. Rates could go back down, and that's what we're worried about. Is we want to make sure this next cycle, when rates do go down, that we're prepared for it, and these lenders can't take advantage of borrowers.
So that reminds me, when we were off camera, we had this conversation a little bit. You don't necessarily. Do you have your speaker on? I can hear myself.
I can hear.
Oh, okay. You don't necessarily have to refinance back into a 30-year loan, do you?
No, you can. You can get any term. So you have 10 years.
Do all lenders allow that, or is it?
I don't know.
Most do.
I would say most do. Any lender that sells to Fannie Mae has the ability to do it, and I don't see any reason why. Our origination systems allow you to change the term down to the month. So the 30-year mortgage is 360 months. You could do the next at 345 months if you want to. That way, you're not resetting the clock. It's amortized over whatever that term is. Your rate isn't going to be any lower necessarily until you get to, if you're between 20 and 30 years, you're paying the 30-year rate until you get to 20 years. So you can refinance into a 32-year or not 32, but 28-year loan or a 27-year loan instead of going back into a 30 and resetting it. Obviously, again, another refinance trick of lenders that I would say unethical loan officers that don't explain things. Sometimes a lot of savings from refinance goes from you have 25 years left on your loan, and they're spreading your payment back out over 30
over 30 years
Yes.
or over 30 years instead of 25. You're erasing all of your savings. And if you remember the first time you got your loan and you looked at your mortgage statement and you realized that the overwhelming majority of your payment went to interest, and that slowly decreases and you get parity at about 11 years, 15 to 11 years between principal and interest, well, you just erased all that. You went back to paying all interest on this new loan. So I think we almost swerved into a completely different topic, but I think it's an important one because you're right. I mean, real estate and interest rates are cyclical.
And
the last 10 years were an anomaly.
It's for any product too. So if you bought a property, you had PMI, and 5 years down the road you can eliminate the PMI. Why go back to 30 years when you can stay where you were, get a 25-year term, and eliminate PMI? So you're even if your interest rate goes up a little bit when you're dropping that PMI, it's still, the numbers are going to make sense in a lot of cases.
Yeah. You know what? We need more nerds.
That's going to figure that all out for you.
Yeah, we just need more nerds. We need less telemarketers and more nerds like us that geek out on the numbers, and I mean, it has to make sense, man. This is, and explaining these things to consumers so that they can make informed decisions is the single most important part of this. And that's the reason why I have guys like you on here, so that people know what it sounds like to talk to somebody who actually is looking out for your best interest. So, I mean, I guess my last question is, did it work? Did we protect our veterans?
I think the way it's set up, it should work. We'll see what happens when rates go down, and see what some of these lenders are doing. I'm hoping that a lot of the lenders that were doing this are just going to go away and hopefully go out of business, because they deserve.
I hate for people to lose jobs, but they never should have been in business in the first place.
Yeah, and good people find jobs anywhere at reputable mortgage companies. So not too.
Evan will teach you how to do loans the right way. Go work for him. Exactly. Okay, cool. Well, thanks again. I appreciate it. We're going to have you on here a lot more, digging way deeper into VA loans and some of the nuances and some of the really special things you're able to do for eligible veterans. And here we go. You know what? Before we go, we've got somebody here that has a question.
Chris is a mortgage broker.
Is he? Okay, so he must also be a veteran, and somebody called him. He's mentioning one of these companies that are famous for.
So Chris, if you're still on, is that for a cash out refi or an IRRRL that they want you? That they're looking to do that on. I'm thinking maybe they're trying to go after cash out refis now to see if,
because cash out refinances don't have the same guidelines necessarily. Correct. Well, they're not as simple.
They'll need the 6 months of payments, but cash out refis.
Chris reported back. So you were right. They pivoted. It took them exactly, what is today, the 20th? Yeah, it took them about 15 days, but trust me, they had it figured out before
company they didn't happen. Surprised either. They were one of them.
And they pivoted straight into another way to strip veterans of their equity. So I guess my advice is don't do it, man. If people are hounding you, God, I hate to say this, but never do business with somebody that calls you or sends you a postcard. Look for people like Evan. Look for people like Chris. He sounds like he knows. You know what? We're starting to wrap up here, but we're getting a couple people here. So All right, George wants us to keep something in mind, but hasn't finished his thought yet. Well, let's keep this conversation going. I mean, anybody, we're gonna stay on this thread. Anybody has any questions, we'll be notified and we'll continue the conversation.
Yeah.
But for now, again, I can't thank you enough, Evan. I look forward to these future conversations, and we will see you next time, my friend.
Thanks as always for having me.
All right, well, see you. Bye-bye.
Yeah.